Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I'm your host, Jeff Snyder. So glad you could join us, and I'm going to be joined later on throughout the program by members of the media, academia, and financial services analyzing all the news in retirement markets, technology, personal finance, so much more. You're not going to want to miss this show. It's going to be great. So sit back and relax and enjoy this episode of BRN Sunday podcast. But we're going to kick things off a little bit differently today. We're going to talk tech, and we're going to welcome back to the program. We took a week off. Daniel Klein, Senior Technology and Consumer Products Reporter at The Motley Fool. Hi, Dan. Welcome back to the program.
Jeff, thank you for the week off. My voice was right at the edge of not working anymore.
Well, I think in all clarity, it's not for me to give permission for weeks off, but I think you certainly deserved it, noting all the hours and time that you're committed to the Motley Fool live show, and also the amount of written digital work that you're turning out. So kudos to you. I'm so glad you're back with us.
Yeah, happy to be back. This is the first month in the history of the 6 years I've been at Motley Fool that more of my income has come from not writing than writing. So if that gives you any idea, I've been talking for my supper.
There you go. Good for you. Well, you're certainly good in a lot of different ways, and it's always good to kind of branch out and do all different types of things. And if anything, the economy has shown us that it's important to differentiate and to do lots of have different skills. So kudos to you. So let's launch right in. I know there are a couple of big topics this week that you wanted to talk about. One was robotics, but the other was Facebook and Twitter and social media. Why don't you go ahead and weigh in?
Yeah, so I want to talk the responsibility of social media to make sure what's on the platform is true. And I'm going to do that without in any way getting into the political debate. This isn't a question of what you believe. It's a question of, is what you're seeing real? Mm-hmm. So there's a real problem on Twitter and Facebook that both have standards in theory, but those standards aren't really applied.
Right.
So I could go on Twitter and I could post everything you know about, I'm trying to think of something, measles isn't true. It's all the ant people. They live underground. They are transmitting this disease through radio waves, and that's how people get the measles. And because I'm not that famous, Twitter might take it down, but they might not.
Sure.
And people might start sharing it, and they might start believing it. It speaks to their worldview. Oh, yeah, geez, the measles, the ant people, I totally get it. I connect them. And I'm trying to be as silly as I possibly can.
The evil ant people, right? I've heard about them. They're against retirement savings, too, I think.
Right. I don't. Well, think of it this way. You could also have someone who's saying the best strategy for retirement is not planning and relying on Social Security.
Yeah,
that's just bad advice. It's not factually wrong, but there's a really difficult, I mean, it is factually wrong, but you're allowed to have a stupid opinion. There's a real gray area, and it's kind of a lose-lose situation. If Facebook comes out, and let's pick a celebrity everybody loves, Tom Hanks. Facebook comes out and says, Tom Hanks posted this thing, and it's not true, we're going to take it down. Well, they've just angered like 80% of America. Even if it isn't true, even if somehow Tom Hanks got hacked, and somebody posted on his account, all of Congress has been replaced by robots. Don't believe them. Get a gun. Revolt. And of course, Tom himself didn't post that, but somebody did. Mm-hmm. If Facebook took that down, Twitter took that down, there'd be a backlash. So they're in an impossible situation. What Facebook has done is they're putting together this big, impartial, in theory, jury that's supposed to look at flagged content. That's going to work until they take down content from someone who's popular. And that popular could be a political figure, could be an actor, could be, look, we had that whole controversy where Jenny McCarthy got in a lot of trouble over vaccines.
Yep.
I would honestly not care what Jenny McCarthy's opinion is on almost anything except, I don't know, maybe fashion, or I don't know, bikinis. Like, it doesn't seem like you should really care what she thinks about vaccines, but somebody saying something that doesn't match with the science can be really dangerous right now.
Yeah.
But it puts those sites in a really tough position. So like, one of the things there's a huge amount of debate on is, should we be wearing masks? And I will tell you, the CDC and the World Health Organization not only recommend we wear masks, but have put out data that if 70% of us wear masks in public, this thing will go away faster. We'll all be in better position. But some people believe that's not a great idea. And so the gray area is, could I say, hey, wearing a mask is uncomfortable, and for some people with breathing issues, it's not viable. Yep, that's the 30% who don't wear a mask. That makes sense. Could I say, hey, if you wear a mask, it's going to elevate your CO2 levels? Well, there's been countless studies saying that's not true. So at that point, should it be flagged? Probably. Are they going to flag it? Maybe not. It's a really difficult situation, and it's exacerbated by our political divide. If I'm a big fan of, I don't know, a politician who supports one thing and they flag his thing as being, not true, I might get angry.
Yeah,
and I might take my business elsewhere. And what I would say is, people, let's focus on what's the truth, not what your version is of the truth, not what you want the truth to be. Look, I wish we could all go back to normal. I miss normal probably more than anybody. But right now, there's just some basic things we should all be doing, and it probably doesn't make sense to be advancing conspiracy theories, about what's going on. If you're posting that, the Koch brothers or George Soros, to pick people on two very opposite sides of the aisle, virus in a space lab and are using it to control people, well, you're an idiot and you should be flagged. And the problem is, if they do it, they will lose audience. So as a society, we have to understand free speech is your ability to speak on your own. It's not your ability to speak on a privately owned, or in this case, publicly owned, they're public companies, platform. They have the right. Just like you can't yell fire in a crowded movie theater, there are rules about what you could say online, and I would like to see there be some level of enforcement, but I totally understand the impossible position these companies are in.
Yeah, Dan, I mean, what does it say? So, when it comes to the Broadcast Retirement Network, and I'll just speak as a business owner, we post our content primarily on LinkedIn because it is a more formal platform. It's educational. You don't see a lot of the. I always have viewed Facebook and Twitter as more fun sites, meaning you see John Doe or Jane Doe, they're an actor, actress, or someone else, someone notable figure pointing something, and they're doing something. So I don't put a lot of weight in those sites in terms of delivering news. And I think what you're describing, to me, it's like, I don't get my news from Facebook. I don't get my news from Twitter. If I want to get news, I'm going to go right to a source and digest it, and then I'm going to think it through, and I'm going to, because you can turn on TV and people say all sorts of stuff for 5 minutes and a 5-minute hit, right? You know what I mean? And they can say whatever. None of that gets checked out. So, I mean, is it just come down to we need to be a lot more thoughtful about where we get our information from and really think about how we process our information?
Yeah, I think it's fair to say the average American doesn't understand sourcing. And I will say my Facebook is largely people I grew up with or people I somewhat know, plus friends and family. Mm-hmm. So there's all political views. And there's a few people I've muted because they're just, ridiculous in terms of their politics. But there's definitely differing opinions on my Facebook. And I've seen people on both sides of the aisle share something that when I look at the headline, I'm like, well, that's not true. And you look at the source, and the source is like some media you've never heard of. So I always Google it, and it comes up quickly. Well, this is biased in this direction. This is biased, or this is a parody website. Like this was
Onion
never meant.
Right?
Yeah, but like if it's not the Onion, nobody knows what it is, so they take it as true. Look, I understand there's this a group of people who want to discredit the quote mainstream media. And I will say the mainstream media is the real media. They're the media that have fact checkers. They're the media that have standards. I worked at the Boston Globe, considered a liberal publication. The editorial page is liberal. Occasionally, I would go to a meeting and the focus of a news story would be how much is this person paid? And I would say, well, how much is that person worth? What value did they produce? And I would get a little bit of pushback. But for the most part, reporters at CNN, Boston Globe, New York Times, Wall Street Journal, wherever you happen to be, their goal is to ferret out the truth. And all the people who say, the media is left leaning, where did you learn about your Bill Clinton and Hillary Clinton scandals? Where did you get all of the ridiculous coverage paid to made up things like, the Barack Obama birther scandal? All of this came from the mainstream media. Now, there is lots of credible small media. You might never have heard of, say, ProPublica, but they are very, very credible. There are lots of, Connecticut has a statewide nonprofit that's doing amazing state house reporting with great journalists. But do your homework on what you're looking at. A lot of the health information you're seeing right now is coming out of sites that have a bias. They're trying to sell you something. They're not necessarily media. So you really, really have to do your homework. And if you've never heard of it, or you've heard of it for the wrong reason, look, if you're on if you're on a site that has an agenda, that's not that hard to figure out. Just Google, is this site credible? And you'll get your answers. And that's true, again, both sides of the aisle. I'm trying painfully hard to not be biased here.
Yeah. Yeah, it's really interesting. I think what I always do is I always look at the about section. I try to figure out exactly who the people are. But, I kind of am in it every day. So but when I pick articles for the Morning Pulse, my newsletter every morning, that really is, I go through and I make sure that they're all reputable sources. They're not like these sources where they're just saying, all pensions should be abolished. Or, I'm
Right.
very clear about how I go and validate sources. But really interesting topic. Let's shift gears. I want to talk about automation, barista automation. I know it's a little bit of a lighter topic, maybe, unless you're a barista, if you even pronounce that correctly. But tell us about that one. That's an interesting story too.
So I think it's barista.
Barista,
but
my bad. There you go.
so
I'm fired.
here's the thing. If you're a barista, a high-end barista, you have nothing to worry about. I am drinking a cup of coffee right now. It is a French vanilla made by a robot. My office has a robot coffee maker, and it works reasonably well. It makes an okay cup of coffee. It's the same coffee maker you get in an American Express Platinum Lounge or the Diamond Lounge at Caesars at any of their properties. So it's an okay cup of coffee. And if you go to the airport, some of the Washington airports, they have lounges where you can order off an iPad and no human is making your coffee. And it's fine. But in this case, there's robots that are making and delivering coffee in order to promote social distancing. And what I think you are going to see, Jeff, are you familiar with Luckin Coffee, the beleaguered Chinese company?
No, I'm not drunk. I'm not a coffee guy.
Oh, well,
personally.
you haven't been to China in a while. So
No, ever. But I would love to go see the Great Wall and all the other great sites. But anyway, no, I have not.
Luckin is a company that was built around. They have kiosks instead of stores. Everything is automated. It was a delivery or pickup business. They had some financial scandals. They're probably going to end up delisted. But you're going to see that model here in the U.S., where instead of a full-service Starbucks, there are some airports where you can order on an app, you go, you pick it up in a window, and some of that is about getting the people out of it. Some of it is about convenience, and some of it is that, look, a Starbucks cup of coffee is largely automated. As much as there's a person who's actually pulling the shot and pouring some of the stuff in, the computer is deciding the pressure, all the other things. So you're going to see more and more of this, and it's going to extend into other food. Robots can make your pizza. Robots can make your Big Mac. Well, this is not good for people. Well, robots can't chef your high-end dinner. Robots can't make a very clever cup of coffee at a high-end coffee shop. So as a worker, what you're going to need to do to survive is you're going to have people skills or exceptional barista or cooking skills. Because a lot of the very basic jobs, if you look at Starbucks now, they are trying to automate anything that can be automated, but they're not cutting headcount. The goal is that the people are going to focus on what you want, the level of production that they need to do that's not automated. And some things, like if you go to a button and it gives you whatever it is, it's not as good as a Starbucks latte. And with Starbucks, you could say, could you give me 3/8 of a shot? And like they could do that. So there's a lot of argument for people, but there's going to be less people. There's going to be more people talking to you and less people making your stuff or taking inventory.
Yeah, and I don't want to tease. I don't want to spill what we're going to talk about on the network on Tuesday because we're going to talk about that a little bit later on. But even tech workers, Dan, are worried about automation. So it's not like it's just in one segment of the economy, right? It is across. We often talk about automation in manufacturing, but here we're talking about baristas. We're talking about other parts of the business that face automation. And again, it comes down to what we were talking about before, which is adaptability, adapting skills, et cetera. So I think you make some really, really interesting points here.
Yeah, I mean, Jeff, let me just jump in and say that the robot in my office can make an okay cup of coffee.
Yeah.
It's terrible at conversation.
Yeah, no, I think you're right about that.
I walk up to the coffee machine. I'm like, oh man, I had a long night. I'm really tired, and it just says enter your drink order. That guy is a one-trick pony in terms of conversation. And I know you've probably chatted with Alexa or Siri.
Yep, Siri.
Not great conversations. Doesn't really go well. So there is a place for humans, but work on your customer interaction skills. If you're going to be a barista, work hard at your craft. I mean, look, Jeff, I know you're not a big drinker, but I'm a fan of going to a bar and sitting down. I cannot tell you how hard it is to get a properly made gin and tonic or Manhattan. I'm pretty sure that's day one of bartender school. Those are pretty basic drinks they teach you. Mm-hmm. So if you want to be a bartender, get really good at being a bartender. There are robots writing earnings stories for Reuters. Those robots aren't as good as I am. They're not 10% as good as I am. So I'm not worried about them replacing me. So it's one of those scenarios where at the very low end, at some point, guys lugging stuff were replaced by forklifts. But a forklift can only do so much. They can't plan logistics. They can't figure out where stuff goes in the warehouse or how it goes on the truck. So you have to differentiate your skills and keep improving.
Yeah, absolutely. And do you remember, Dan, just real quick, I got about 30 seconds. You remember, you're old enough to remember 2XL? That was a robot when we were kids, well, at least when I was a kid, that you used.
Yeah, I do.
I remember you used 8-tracks. I mean, we're talking really dating ourselves because half the audience doesn't even know what an 8-track is. But it used 8-tracks, and supposedly it talks to you. So when you immediately said robots talking to you, I thought of my 2XL as a child.
I had the later edition of 2XL that used cassette tapes. So I was much advanced. My brother also had AG Bear, and if you had AG Bear and you made a noise, it talked to you. But if you got two AG Bears, they just kept talking back and forth to each other all night until they ran out of batteries. So technology cannot solve everything.
No, absolutely not. Can't even put you to bed. Dan, always a pleasure talking with you and looking forward to having you on the network this week to talk about a panoply of issues. Take care and have a great rest of the weekend.
Jeff, I'm going to look up Panoply, and then I will see you in a couple days.
See you. Bye. Welcome back, and now we're going to talk about the latest social media trends. And LinkedIn is an amazing platform with so much analytical data, and it always makes sense to talk to Devin Banerjee. He's the senior financial services editor for LinkedIn, and he's also the editor of the This Week in Finance newsletter, which of course you can find on that great LinkedIn platform. Devin, thanks so much for joining us.
Absolutely, Jeff. Always good to be with you.
Yeah, and you always pull double duty, and I know all the listeners and the team are really appreciative of all you do to share your perspective and the team's perspective on LinkedIn. So let's dive in. I know you were on the program earlier today talking about the economy, talking about Hong Kong trade status and that seems to be up in the air, But what's top of mind for you? What are you all thinking about today on Friday, afternoon our time, but morning your time?
Yeah, absolutely, Jeff. I'm going to repeat a little bit from the network because overwhelmingly, I think the conversation this week was about signs of life in the economy, and not just the U.S. economy. We had some data come out from LinkedIn and other sources about signs of life globally. So I'll start in the U.S. Data is starting to show things like truckloads growing again, freight movement, shipping movement, other activity like mortgage applications, new business applications. Also things like bookings for travel, flights and hotels are a touch higher. And now, of course, it is important to step back and look at the larger context. Of course, we're in quite a dire downturn here, and analysts do still expect a contraction for the year of about 6 to 7% in U.S. GDP. Of course, for unemployment to linger in double-digit percentages through the year. But really, what we're seeing is that conditions in some parts of the country have stopped getting worse. So they're bottoming out. And if I pull up some data here, our LinkedIn hiring rate, and again, we're looking across our 700 million members and the tens of millions of jobs on the platform, we're seeing that globally really show some optimism. So in Europe, places like France and Italy are showing quite strong signs of improvement. Now, of course, all of these places, the hiring activity is down now compared with pre-pandemic. But again, as I said, what we're seeing is that rate bottoming out and starting to tick up. Same in China and same in the U.S. And we put out some of that data just yesterday. You can see it on my colleague Brian Shu's profile, last name XU.
Okay.
And then also we're seeing this in our neighbors to the north in Canada. Retailers are reopening there, so are factories. More jobs are being advertised. I think close to 40% of small businesses now report being open in Canada. That's up from 21%, so double from just last month in April. And we're also seeing a lot of that in the UK. Now, of course, as I said a couple of minutes ago, tempering expectations. We saw the Fed's latest regional survey on Wednesday, what's called the Beige Book. And there was some real reality checks in there. And among those were some Fed data showing that many workers who lost their jobs are now quite reluctant to return to those jobs. Companies reported challenges in bringing employees back to work, including health concerns being top of mind for everybody, but also limited access to childcare right now. That's going to be a really interesting dynamic to deal with as companies think about bringing people back to work.
Yeah, I'm right there with you, Devin. I mean, I'm not a parent, but I have to applaud those parents out there because, look, they are managing the family. I mean, secondarily to the healthcare workers and the frontline workers, of course, right? But I think it's really amazing what those people are doing to teach their children as well as maintain their jobs.
Absolutely. And I've seen it with my own team as well. Those who are parents, we're in meetings parts of the day. And then just yesterday, I was in a meeting with my boss, and he said he was jumping to do PE class with one of his sons just at home in the living room. And then he would come back to work after that. So there's a lot of juggling going on, and we have to keep those. It sounds kind of basic or trivial, but it's really fundamental. I mean, it's all human capital and people's time. They're only 24 hours in a day. And this is all really fundamental to how we bring people back to work and how swift that recovery is. And speaking of the swiftness of the recovery, some more data out from the government this week from the BEA, the Bureau of Economic Analysis, found that the saving rate has skyrocketed. As a matter of fact, in April, the savings rate shot up to 33%. That's the highest since the BEA's records began in the 60s, and that 33% compared with just 12.7% in March. So savings sounds like a great thing, and in many cases it is, but economically that's money, not being spent, money not being moved around. Spending fell in April by a record 14%, according to the BEA. So again, thriftiness can be rational during an economic downturn. It totally makes sense. But it definitely can influence the pace and shape of that recovery. So we're seeing this real push and pull. You can tell, some factors for optimism, signs of optimism, but also a lot of stark realities with, as I said, human capital and health concerns. We can't forget that this, at its root, is a health pandemic. And if workers are not comfortable commuting, public transportation, or coming back to an office in a building with an elevator where they have to ride 40, 50, 60 floors up, then that can just stop things in its track.
Yeah, I think we all those of us who are not directly impacted by the health consequences of the pandemic often push it aside because it becomes more of an economic impact to us. But I think you're absolutely right. Really interesting data. It just got my mind going when I think about the BEA data. Yes, savings rate skyrocketed. But then I think about all those small businesses, right? If you're not out spending money and you're saving money, and look, I'm the first person in the world who's going to talk about savings, but you gotta, we are a spending, consuming economy, right? I mean, people go out, they've not been able to go out and have dinner, for example, or they've not been able to go on vacations. I think that certainly will happen over the next several months as people kind of resume some level of normalcy. But you got to think it will have an impact. I don't think the savings rate stays where it is now. Even though those of us who applaud that and want that long term, I mean, it just doesn't make sense from an economic point of view. A lot of that was forced. And I think you bring up another good point, which is unemployment. We have a lot of people who are unemployed. You mentioned people that are not returning back to work because of all these concerns. Again, that's going to hold back some of that consumerism that is really important to our economy and other economies around the globe. So I think until we get this vaccine, when that is, we don't know. We know there's some good moves in the right direction, but until we get that vaccine, I think there's still a lot of trepidation and a lot of unknowns.
Yeah, absolutely. And the last thing I just want to point people to this week, I won't go through the whole story, but a really fantastic story in the Wall Street Journal by my former colleague and friend Chip Cutter about how bosses and managers should manage bringing employees back to work, specifically the topic of how much information you can ask of employees about what they're doing off the clock. And this is really relevant as the weather warms up and, people start heading out of the house again, hitting the beaches. And of course, hopefully they're doing that responsibly. But can employers ask their employees where they've been over the weekend or what their plans are that night or where they've been the previous day, et cetera? So really fascinating story. Legal experts are weighing in with some advice for managers. And so a lot of people who have teams and are thinking about this topic, it's just a really fascinating story. The takeaway, I'll just mention that the takeaway I took from it is that companies should really step up their role as educators of smart practices, and leaders should seek to inspire their workforces rather than take a heavy-handed, authoritarian or authoritative approach and sending employees forms or trying to force them to divulge information. I think inspiring them to be responsible and educating them about how to be responsible is definitely the smartest approach. Yeah,
well said. I agree with you on that. And Devin, I want to thank you so much for always doing double duty. Great insight into some very important analytical work. Really appreciate being on both shows today. Have a great weekend. Stay safe, and we'll talk to you again next week.
Sounds good, Jeff. Take care.
Bye. Welcome back. Now time to talk markets, and joining me on the line, he's the co-founder of Delphi Digital, Mr. Kevin Kelly. Hey, Kevin, how are you?
Doing well. How about yourself, Jeff?
Doing okay. It's end of the week. It's been a short week, but these days and weeks kind of all run together in this in the pandemic times. And I want to add just before we get to you and markets, just real quick, Oliver Rennick, who's normally part of our segment, he is off preparing for his TD Ameritrade Town Hall. And so by the time people listen to this, it will have been concluded, but we're recording this on a Friday afternoon, and he is in Chicago rehearsing and prepping for that. So, Oliver, best of luck to you, my friend. People can definitely check it out on TDAmeritradenetwork.com. There's a repeat. I think it's running all weekend long. Okay, Kevin. Sorry, didn't mean to steal your thunder here, but I just wanted to make sure we plugged Ollie's show.
No, not at all.
Let's jump in. Why don't you tell us about the week that was, and if you want to inject some stuff about crypto, I think we're all ears here.
Yeah, no, absolutely. So this week, as you mentioned, short week, but definitely pretty jam-packed. If you start with equity markets, you've got the market back, the S&P above 3,000, bringing above kind of a crucial, I guess you'd say, psychological level for a lot of people. But what you're starting to see transpire, as we've alluded to, over the last couple of months, is we're now in this really interesting and, quite frankly, a kind of awkward phase where the global economy is starting to reopen slowly but surely. You're starting to see that across different states and even different parts of states here in the U.S. And so far, so good, at least for some of the reopening plans, here domestically. But that's not to say we're anywhere near out of the woods. There's obviously fears over a second wave, and so there's a lot of questions right now around, how sustainable is this relief rally within the equity market? Bond market is still, yields on 10-year treasuries, for example, are still around 65 or 70 basis points, which is very low. They plunged, if you remember, back in March, and really have kind of hovered around the same level because you don't have a lot of expectations for inflation picking up and a number of these different things. And so I think what we're at, long story short, is another interesting inflection point where, policymakers are sitting here at a critical juncture saying, do we continue to run this current playbook and, continue to ramp up fiscal stimulus and have, our debts monetized by central banks like the Fed and kind of run with that playbook because there is still a lot of damage and small businesses and firms and companies that are in need of funding to continue to keep the lights on? Or do they try and go the more, fiscally conservative route, which you're seeing a bit of pushback in places like Europe on, because there are, looming concerns over, these rapidly rising, debt to GDP levels. But going that route obviously risks a sharper downturn, in which case policymakers would have to come in anyway and probably ramp up, their stimulus efforts even further than maybe they would have if they just decided to keep with the same old playbook. Now, what that means long term is basically the outlook for greater debts and greater debt monetization. I think it's here to stay for at least the coming months and through the end of this year. Where that ends at this point is really anybody's guess. But I think, again, there is still this large disconnect between your U.S. large cap equities like the S&P 500, for example, and the underlying kind of outlook or what's happening on the ground, here with the underlying economy.
Yeah, I think you make a good point, and just from the lay person's point of view, people live in all different parts of the country. There's all different plans to reopen, different markets, different local economies are going to be impacted differently by this. Kevin, how much does the market build in? We've seen a real good, as you alluded to, a real good run in equity markets this week, although I think the market was down slightly as you and I were speaking, but I'm not watching it as we're talking because I'm talking to you. But how much does the market build in the potential for a second wave? How does it look at that? And what can we possibly expect over the course of the next few months?
Yeah, so I would say, you have seen the markets pull back a little bit here. A large part of that is due to Trump coming out and saying he has this 2 p.m. press conference that everyone's kind of hanging on to see if he announces or starts to kind of hit on the China playbook, right, and increasing, whether it's tariffs or just coming out aggressively again now that we again are starting to see COVID relax a little bit, or at least concerns over it. But no, how the market starts to price this in, to be honest with you, I tend to err on the side of, the market tends to be right. But during periods like this, it's really tough, I think, to know for certain, because when you just look at the underlying data behind a lot of the small businesses and the amount of small businesses that are projected not even to open or reopen, I should say, and they've closed their doors permanently, even if, hypothetically, every mandated lockdown was lifted right now, right? So you're going to see a permanent impairment for a lot of small businesses here in the U.S. and also in Europe with similar dynamics. And so, in my view, at least, this I think is not only an inflection point for policymakers, but I think also for investors and your everyday average layperson, because as the market kind of continues to rise or disconnects from the underlying outlook for a lot of, or a majority of, Americans, for example, it's going to start to really kind of, I think, tear at the tensions that already exist between, for income inequality and wealth inequality, and basically, those with access or those with the capital and the wealth and the assets that were able to kind of preserve their wealth throughout all of this. A lot of people obviously are suffering from job losses and they're blowing through their savings. And on the flip side, you have the rich that are arguably, only, staying richer and potentially even getting richer. So long story short, I think the downside personally is a much higher risk from here than the upside, just given the catalysts, or the lack of catalysts, I should say, over the next couple of months for the equity market. But that's not, again, to say that the Fed and other central banks can't keep pumping liquidity in this market, and some of that finds its way into assets and elevates asset prices.
So, Kevin, I want to switch. I want you to turn your hat around and let's talk cryptocurrency, because a lot's been happening in that space, in digital currencies, digital assets, as a result of this pandemic. And there was a report this week, I think, from Goldman Sachs, if I'm not mistaken, just kind of talking about the impact of the economic outlook to crypto. So why don't you take us through the week that was? You just took us through the week that was in the global economy. Let's drill down and talk about digital assets and crypto.
Yeah, I mean, a great place to start is certainly with that Goldman presentation call that was fortunate enough to listen into. And to be honest with you, I mean, obviously don't want to badmouth anybody over there who kind of put that together. But from our perspective, I mean, we were just kind of largely unimpressed, because it seemed like a lot of recycled arguments against Bitcoin. They were talking about things like illicit payments and how, Bitcoin's still used by drug traffickers. And you could turn around and make a much larger argument that a far greater percentage of that occurs with actual physical cash in dollars, right?
Yeah.
And so it's just those kind of recycled those recycled arguments were kind of, in my book at least, where some of the credibility was thrown out. Because again, I get the argument around, trying to understand what the intrinsic value of something like this could be, trying to pair it to gold. I mean, they came out and said they also, weren't necessarily bullish or even recommending to their clients an allocation of gold. So at least they were consistent in that regard. Because it doesn't produce cash flows and things that they would look for at least on the wealth management side, putting some of their clients into different asset classes. But yeah, I mean, long story short, I think it was just a lot of recycled material, and basically looked like, somebody read headlines, off a mainstream financial media site, and basically just dropped that into a presentation and tried to convince people that, Bitcoin wasn't all it was made out to be.
But we have seen during this time of the pandemic, and again, I'm coming at this from the layperson, you're the expert here because you're doing the research, that there has been some stability with digital assets. And I think it's added to some more legitimacy to the market. I mean, when you talk about building financial instruments, it's not built overnight. You have to continue to develop and change and evolve. And I think that's what's happening here with cryptocurrencies. Is that your rationale as well, that we have some more stability in these assets relative to some of the other assets out there?
Yeah, certainly. And again, it's one of those markets where right now it's just almost impossible to take a really kind of passive approach. And by that, I mean, aside from really holding Bitcoin as a longer term investment or some of these other, maybe larger cap crypto assets, it is a market in which you need to be active or allocating to somebody who is active, because it changes very quickly, right? So the risk is certainly still there. But to your point, I mean, yes, we've seen, greater stability, the volatility of, Bitcoin, for example, relative to even other asset classes like oil, which was very volatile this year, but also, U.S. equities, that volatility spread has compressed, which again starts to kind of weigh on the argument that it's too volatile for people to own. And I would say the last point about what we're seeing in terms of just the developments is you've got this rise in what they call stable coins, which we've talked about before on your show, in which, you've got basically a reserve of dollars, for example, and people issue a digital currency that's backed 1-to-1 with the reserves. And so we've actually seen an explosion in demand for these, in part because people are looking for dollar exposure in a world in which we have a pretty large global dollar shortage. And it's a really interesting kind of thought exercise if you think about the long-term ramifications of this. If you can create digital assets that eventually aren't even necessarily backed 1-to-1 with the US dollar, but you design the mechanism so that it tracks or is pegged to the dollar very, very closely, that creates a really interesting kind of digital euro dollar market that anybody could have access to. It would be a permissionless system that doesn't exist today. So when you think about safe havens and trying to, shore up dollar cash reserves and things of that nature, that could create a really interesting kind of power dynamic between those who issue, U.S. dollars, which is the Fed, versus, this new kind of parallel digital, crypto decentralized financial world that's being built.
Yeah, I mean, I think it's. I was just thinking as you're talking about these stats because we talked about the global economy and then we talked about Bitcoin. Do you and the team get any sleep because you have to be reading and analyzing things all the time? I mean, you guys sleep?
Not a whole lot, and that's because we're just obviously excited to research out of the space. Luckily, we've got a few European partners now as well, who, when we end up shutting our eyes and putting our heads against the pillow at night, they're just waking up and getting into this. So we've got kind of round the clock coverage. So we'll wake up and to a new report or something that one of our guys over there is putting together. So no, I mean it's just a really exciting time, and there's so much information to try and consume and make sense of and put into a format in which people can digest it. That we've certainly cut back on sleep, but I wouldn't say it's necessarily because we didn't want to. It's just we're passionate about this space, and luckily we've got a good group of guys who are all kind of on the same page about it.
Yeah, it sounds really interesting. Sounds like a lot of fun. Great group. Kevin, always a pleasure talking with you. Have a wonderful weekend. Stay safe, and we'll talk to you again next week.
Hey, Chef, appreciate it. You too.
Bye. Welcome back, and now we're going to talk real estate and travel, and who better to do that for us, with us, is Dow Jones Market Watch's intrepid travel and real estate reporter, Mr. Jacob Passy. Hi, Jacob. How are you? How was your week?
It's been a busy week. Lots of news all over the place, but a good one.
Yeah, I mean, I don't know how you do it. I mean, I know you guys. Every journalist that I talk to is doing a tremendous amount of writing, whether it be for your publication or others. And I guess there's lots to talk about, lots of different angles, and people are craving a lot of news. So I'm really, really happy that you could make some time out of your busy schedule to join us. So where do you want to start? Do you want to start real estate or do you want to start travel?
Let's start real estate.
Okay.
So this week, mortgage rates hit another all-time low. So that marks the third time this year that has happened, which is pretty remarkable. The average rate for a 30-year fixed-rate mortgage, according to Freddie Mac, is now at 3.15%.
Wow.
Which is incredible. So we figure if that's the average, about half of those, roughly speaking, it's not the median, but it's the mean. But nevertheless, about half of the rates on the market are below that. So certainly, lots of folks out there probably getting rates even below 3%, which is incredible. And the good news for folks out there is, the experts I spoke with, said that all signs seem to be pointing to rates staying low for much longer. The good thing in the mortgage market right now is it's kind of gotten back in line with bond yields. So I think I've talked about this on the program before, but mortgage rates roughly follow the direction of, the 10-year Treasury notes and other, kind of long-term bond yields. And so when bond rates drop, so typically do mortgage rates. But because of a lot of the issues that the mortgage industry was facing because of the coronavirus pandemic, specifically all the forbearance requests that they were getting, a lot of companies couldn't afford to drop rates as low as they would have, given the fact that bond yields have come down. And bond yields have come down because a lot of people had fled to those as kind of a safe haven for their money, for their investments, given all the stock market volatility we've seen.
Yeah.
So the good news is that relationship between mortgage rates and bond yields has kind of repaired. There's a lot more stability in markets right now, a little less volatility lately in the past couple of weeks, and that's been a good sign for the mortgage market. So that's made it so lenders feel comfortable charging a lower interest rate. And so, if you're looking to buy a home, or you didn't get a chance to, get in the refinance wave earlier this year, you still got a great opportunity to do so.
And then is it your sense, I mean, that's incredible news for a lot of reasons that which you just talked about. Is it your sense that the housing market, I think we've talked, and it seems to be opening up a little bit in certain pockets of the country. Is this a good sign that there's more to come in terms of getting people back to buying homes and selling and all these other aspects of real estate?
Yeah, so low interest rates are definitely encouraging people to re-enter the housing market. The Mortgage Bankers Association tracks the number of mortgage applications on a weekly basis, and for 6 consecutive weeks now, the number of applications placed for purchase loans, which means mortgages used to buy a home, has increased. It's now 50-some-odd% above where it was at the beginning of April when it kind of hit a low because of the coronavirus pandemic. So that's a great sign. So that shows, that's kind of the first thing a lot of people do in the home buying process, even before they start to look, is line up their financing, because you want to have your mortgage kind of ready to go, that if you want to make a deal on a home, you can kind of just lock it up pretty quickly and whatnot. So the fact that the number of people applying for purchase loans continues to increase is a great sign. I think a lot of economists kind of are thinking that the spring home buying season won't necessarily have been canceled because of the coronavirus pandemic, but just delayed. So it might stretch into the summer months when normally, sales activity kind of starts to drop as the temperature goes up and up, because folks want to get into a new home before, especially before the start of the school year.
Yeah,
so so we'll see a little bit of a different kind of dynamic this year. The only issue in the housing market that could affect people's ability to buy is if there are enough listings out there. So the number of homes listed for sale dropped significantly because of the coronavirus pandemic, because sellers were just really nervous about putting their home on the market, finding no buyers, and then having to drop the price. So a lot of the recommendations out there to home sellers when this all started was to take your home off the market or not even list it if you hadn't already, to protect the asking price that you were looking for.
Sure.
So we're starting to see listings creep upward, but it's still much lower than it was a year ago. And already at the start of this year, before the coronavirus pandemic, economists were saying that home sales activity would be curbed this year because of the low number of homes up for sale. The inventory situation is a major issue across the country. And so that's going to continue into the summer. And so, while there might be more and more home buyers entering the market, there aren't necessarily going to be more and more home sellers entering the market, because you also have to think, if you're a seller who lives in your home, you need to buy a home before you can sell your home. You need to find a place to live before you sell.
Yep.
The exception would be, and I think you and I have talked about this, Airbnbs, things like that, second homes that people might not want to hold on to anymore. There's going to be some opportunity there, but yeah, the supply side of the equation is the issue right now.
Yeah, certainly. We were talking to Devin Banerjee on the program this morning, on the network this morning, about seems like signs are pointing up for the U.S. economy, and this again seems to be a real estate's a big part of that, and this is a really, really good sign. Jacob, I want to change hats with you, if you don't mind, taking off your real estate hat, putting on your travel hat. I know you, because you do double duty on this show, but you also do double duty in print and digital. What's going on in the travel world? Because I think there's some good news there. Things appear to be opening up across the globe.
Yes. So big news this week was Walt Disney World has set a goal for when they hope to reopen. So still have to be approved by the Florida governor, but they're aiming to start reopening their theme parks in Florida starting July 11th. So the Magic Kingdom and Animal Kingdom theme parks will open July 11th, according to their plans to the public. And then a few days later, on the 15th of July, which is a Wednesday, the other 2 theme parks, Epcot and Hollywood Studios, would reopen.
Wow.
But lots of changes going on to the theme parks, lots of new rules. You have to wear, anyone over the age of 2, so that includes children, has to wear a face mask if you go to Walt Disney World when it reopens, which, is something parents need to consider. There's going to be a lot of changes in terms of, they aren't going to be distributing paper maps, so you're going to have to use your phone to get around the theme parks to know where to go. A lot of cancellations in terms of dining reservations. So the news came out yesterday that Walt Disney World will be canceling all dining reservations that were made for the foreseeable future, and then they're going to eventually reopen them. But the issue basically was, and folks who haven't been to Disney may not know this, but at Disney World, you can make dining reservations up to 6 months in advance. So a lot of the popular restaurants
Wow.
already were fully booked for months and months. But because of social distancing requirements, they're going to have to rethink how many people can go into the restaurants. And so they've canceled all dining reservations, and now you can only make dining reservations 60 days in advance once they eventually reopen those. Another big change, Fast Pass, which is the kind of feature where you can, save a spot in line, so you don't have to actually wait in line. And you reserve those in advance as well. So much planning goes into a Walt Disney World vacation. So Fast Pass Plus reservations have been canceled. And the last big one is that they're not actually allowing new hotel and theme park ticket reservations right now. So you will eventually, when you go to Disney World, if you choose to go, you will need to make a reservation to be able to enter the park. So in anticipation of that, a lot of people tried to buy hotel stays or buy theme park tickets, and Disney put a pause on all that. So it's only people who had existing reservations right now who have any sort of guarantee. Disney may eventually reopen that, but yeah. And then lots of changes to the experience. No parades, no fireworks shows, no meet and greets with characters. So it's going to be a very different experience when Walt Disney World reopens.
Yeah. Well, obviously, I mean, I think I don't know how children will take this all, but I have to think that parents will have to do some explaining. But I think it's again some more positivity going into the weekend. We like to talk about optimism. That's really it's a great first step, knowing that no one really knows how long this is going to last, and no one knows if we're going to have a second wave. So I think people are kind of feeling out how they're going to open and run their businesses. So Jacob, always a pleasure chatting with you. Really appreciate you doing double duty. Stay safe and have a great weekend. We'll talk to you again next week.
Yeah, talk next week.
Bye-bye.
Yeah.
Bye.
Welcome back. Now we're going to switch gears, talk what's going on the legislative and regulatory front. Joining me on the line, they are two principals with Groom Law Group, David Levine, Kevin Walsh. Gentlemen, welcome back to the program this afternoon.
Thanks for having us on, Jeff. I think as our segment will show, this has been with the holiday weekend, has been a slightly slower week. The big news around D.C. is that phase one of reopening began today. So you're able to get dinner outside with up to 5 other people at some restaurants, which is a huge development.
And Kevin, it's kind of ironic you go to that because I hear you standing outside as we record this. Are you leading the way for us this week?
I've got my face mask on and I'm trying to figure out how to get the beer to my lips.
I understand. All I know is in our household we're making face masks, and this is true, but the factory output's a little slow. It's about 1 a day. But I got to admit that we're making progress, and it's a positive thing. So I appreciate my family. But Jeff, I figure people want to hear about what's actually going on. What do you think?
Yeah, absolutely. Give it to us. Drill down, guys. And by the way, it's nice to be back in the host position this week after you guys took it over last week, but that was fine.
It was like a takeover, and clearly,
it was a coup.
And clearly, it showed why.
It was a very unsuccessful insurrection.
No, it was great. You guys did a good job.
Very unpopular. Very unpopular.
No, I think you guys got more ratings than I did. You guys got better ratings. You can guest host anytime.
We're just going to burn our time talking about guest hosting.
So
David, substance. Could you
David, what's going on with the IRS?
Yeah, David, tell us what's going on with the IRS.
Am I going to be allowed to talk, or are you guys just going to keep talking so I can't even talk at this point?
No, you can talk. Go ahead.
Oh, okay. So, believe it or not, as Kevin said, it was a relatively slow week. We got one piece of guidance, which, last year we spent all year telling you you're going to get something, and finally we did. This year, it's like, what did we get this week? Well, this week we got Notice 2020-35. It's more extensions. And rather than walk everybody through a long discussion about funding waiver relief and other things, some key takeaways. Let's just cut to the quick. The remedial amendment period for when you can actually, adopt the new 403B plans with the model documents is pushed to June 30th, 2020 in this guidance, number one. Number two, the pre-approved defined benefit plans, a bunch of the changes there about adopting documents is pushed out until July 31st, 2020. Now, there's other items out there like excise tax returns and things, but one thing I want to talk about is a need that we actually need to address. For individually designed plans, especially hybrid plans like cash balance plans, there's another deadline coming up that later this summer, end of August, for submitting a determination letter on the plan under the IRS's special window. I'm seeing an increasing need this week and interest in pushing it out because a lot of the people we work with who have defined benefit plans with hybrid formulas who wanted IRS blessing, they've been a little busy on CARES Act, coronavirus types of issues. And they're still very interested in determination letters, but I'm hearing increased interest in asking the IRS, and the IRS has been really flexible, and hopefully this continues, about pushing out that deadline as well. It'd be great, for instance, if it went to the end of the year. That's my ask, because obviously we have clients who want that, but it's clearly an interest item to talk about. But aside from that, this week was a relatively quiet week, because, Kevin, maybe you can tell us, what's going on in Washington other than voting by remote control this week?
So remote.
And now we're losing Kevin.
Kevin, we lost you, buddy.
Kevin, you still there? See, this gets to the discussion of remote voting, Jeff. I figured Kevin, as soon as he gets voice back, will come in. I'm going to riff here for the moment.
Yeah, absolutely. I think that's a big problem.
CARES
So-
4. Oh, wait, Kevin's here. It's about time you got here.
I'm here. I wanted to have like a little pause there just to build some excitement.
You did. You built some excitement.
Did you click through the warning flag on the Broadcast Retirement Network that this could be something that's controversial or inciting violence, and that's why you weren't ready to speak?
Well, so kind of the update on DC is that this weekend, Assistant Secretary Rutledge is stepping down at EBSA, where he's led it for the past 2.5 years. And then currently Deputy Assistant Secretary Gene Wilson will be moving up to be the acting Assistant Secretary. And then the other news, and that's kind of the only thing on the regulatory front. Right now there's still some guidance with respect to a request for information for pooled employer plans that's sitting over at OMB. So we'll likely see that in the next couple of weeks, but there's been no real guidance coming out in the past week. When we pivot to the Hill, the question we keep getting is, where's the next round of coronavirus, either, stabilization or, economic boost coming out of the COVID lockdown. And the two parties are still pretty far apart. So we think negotiations on that are likely to continue into sometime in June. We'll probably see changes made to the Paycheck Protection Program as part of that, or as a standalone bill in the interim. But those are kind of the big things going on. David, did I miss anything, or do you want to provide any color?
No, I agree with you, Jeff. I think one piece of, Kevin. Kevin, it sounds like you truly are enjoying the outside with the audio on the line today. But the one piece of color I'll add is PEPs. I could tell you in my practice, I'm working with a lot of people and seeing a lot of questions on PEPs right now, especially as the people are developing them. So I think the RFI may be one of our big new hot discussion items when we get there. And Kevin, I can't end a call without a missing participant reference. Where are you? Are you missing?
Well, I'm one of those recalcitrant participants who just won't tell you where they are, despite the fact that it would make life a whole lot easier for the plan fiduciaries.
Okay, well, on that note, Jeff, I think we're going to call it a wrap unless you want us to keep going, which I'm guessing most of you nor the listeners really want.
No, I think look, I appreciate you guys coming on. Lots to be discussed in future segments of the show. Thanks, guys, for joining us this afternoon, and look forward to having you back on the program next week. Take care.
Thanks, and I hope everyone gets a haircut.
See you guys. Bye.
Bye-bye.
And that wraps up this episode of the BRN Sunday podcast. I want to thank all of our great contributors who make time out of their busy schedules to join us and analyze all the news each and every week. Thank you to them, and thank you to you, our audience. Don't forget, we're back again tomorrow morning for BRN AM. I'll be joined by Michael Drew. He's a professor at Griffith University. He's also a chief investment officer for MGD Private, and is also a trustee of Q Super in Australia. You're not going to want to miss that show. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.